Hey folks, it's Asim Trading again. So I've done some videos like this before about studying market price action, but it's always good to review these concepts and be able to incorporate them into your trading routine. One thing that I regularly do is I go back and I study the price action of the top relative strength stocks. These were the stocks that often have made the biggest moves. So if you study the price action and the tendencies of these stocks, you start to learn over time what uh, what supply and demand dynamics actually unfold. In contrast to what you often hear, you'll read stuff on social media, you'll read about different concepts, but doing this is studying the actual market itself and the stocks and the supply and demand itself, and understanding these tendencies and nuances, which helps you when you listen to other people speak or you hear them talk about different concepts. It kind of helps you um, frame their perspectives in the correct manner, because I hear a lot of crap out there that's just is honestly just a bunch of bullshit. It's just theory and concepts that doesn't really pass the smell test. And the reason I know it doesn't pass the smell test is because I do this drill that I'm about to show you very frequently, and I understand how price normally unfolds, and it's the basis of why I trade the way I trade. It's the basis behind how I enter and manage positions. I don't do these things just because I read them somewhere in a book. Some of these concepts, yes, I learned about them in videos. I learned about them through books and things like that I've read over the last 20 years. But at the end of the day, it's studying supply and demand and relating that what you're actually experiencing with the concepts themselves. That's what gives you confidence in your approach. It's not just about blindly following what someone says. I don't want any one of you to blindly follow what I say. I want you to take what I'm saying and relate it to your own experience, your own observations, and you either take what I'm saying or you don't take what I'm saying. But I think you'll find if you do this exercise regularly, I would say if you're new to trading, you should do this exercise daily. If you're a little more seasoned and you understand these nuances, it's good to refresh on these things. Maybe once a week or once a month, you go back and you study price action, and you just kind of make sure that what you think conceptually lines up with what actually is unfolding in the market. And it just helps to reinforce what you're doing. Helps reinforce your processes, because at the end of the day, it's not about perfection. It's not about being right. It's about having a solid process to identify high probability setups. It's a process of entering these setups at an inflection point to where you're most likely to get some sort of follow through after you enter. It's about understanding where should you place your stops to the greatest effect, to where you're not getting chopped out of trades prematurely, but you're giving them enough wiggle room and flexibility to kind of unfold naturally. And we'll talk about some of these things as I go through this process. So, honestly, one thing I just like to do is I have this tab here called All Momo, and it's the same scanning criteria that I've shown numerous times. It's just this general scan that covers high relative strength stocks. And whether you use 90 or 95, like I use 95 typically for the actual trades that I take. But when I'm just throwing a wide net and trying to understand generally the composition of the high relative strength group, I kind of bump that down to 90. Anywhere between 90 to 95 is probably a good sweet spot. Some people like to use something lower than that, 85, 80. I like to stay in touch with the cream of the crop relative strength stocks, so I usually stick with 90 or above when it comes to these parameters. And again, this is just 1 month, 3 months, 6 months, 2 weeks. You can use a variety of different time frames. It doesn't have to be these time frames. It's just you want to use some time frames that are more short term and short oriented, and you want some that are longer. Maybe a quarter or 6 months or a year. Uh, and these aren't even exactly 6 months or 3 months or 1 month. This is just kind of spitballing. If you want to use the exact number of days in a quarter or 6 months, then have at it. It's not that big of a deal. to be that nitpicky about. I have some basic liquidity metrics in here. 20 million daily dollar volume on average is what I'm looking for. 300,000 shares and above. If you want to trade things that are thinner than that, that's fine. But you start introducing wider spreads, increased slippage, especially the bigger your position size gets per position, the more this becomes a factor. And you can see this with the evolution of Koulimagi's trading, where he used to trade smaller and mid-cap stocks. And he talks about how as his account grew, he was having basically forced into larger and larger stocks because those stocks had the liquidity that he needed to get in and out of the position. So those are very important things to consider. And again, like this is just an analysis of trades that have, not trades, but like stocks movements. So this isn't necessarily an important factor for the analysis itself, but you want to kind of study the market that you're going to be trading. So if you're trading higher liquidity stocks, let's say you have a couple $10 million in your portfolio, maybe this number would be 50 million or 100 million as your minimum criteria for liquidity. This is just whatever value you put here, this will pull out stocks that are in the universe of stocks that you should be trading. Average daily range, I put about 4%. Usually when I'm trading, I want 5% or higher, but for analysis, 4% is probably good enough. I want stocks that are, have a 10 period that's rising above the 20 period on the daily. That just kind of shows that the stock is in a general uptrend. So in addition to having relative strength, liquidity, volatility, there's also a trend component here. And then I want to make sure that the stock is held above its recent highs. It hasn't come too far off of its recent highs. There's stocks that they will crater after making a move. These bottom two criteria kind of remove a lot of those stocks. And again, I could throw a wider net. Again, I'm just showing you how to pull out a decent pool of stocks to study. If you just want to use the relative strength component here and study every stock in the market that has some sort of higher relative strength value, then have at it. I've done this process quite a bit of times, so I'm just showing this for example purposes. So if we just sort by average daily range and start at the top, we can make some general observations. So on the left here, I have a weekly chart, and on the right, I have an hourly chart. And this is just to kind of show visually what a trader can expect to see. And right now, we're not gonna come to any conclusions. We're just gonna make observations. And that when you're studying something, in order to avoid biases, it's important that you make observations without making judgments on those observations. You're just collecting observations at this point. And this is exactly what you would do if you want to study a goldfish. You can spend 1,000 hours studying the goldfish itself, but what you want to do initially is you want to just observe the goldfish. Sure, you can read about what other people have said about goldfish and what experts have said about goldfish, and that's a good start in many cases. But from an experiential standpoint, if you just want to understand what goldfish do, you just study a goldfish in their natural habitat. And it's the same thing with stocks. You can read about what other people say about supply and demand. You can read about what other people say about price patterns and setups and all this other stuff. Like, that's great to get some context. But the starting point should be, especially if you're new, is to study the object that you intend to study itself, which is the market and the price action and the stocks. So if we just observe IVP here, it had this very large expansion week last week. And then if you go over here to the hourly, you can see this big hourly bar, or this big weekly bar represented in hourly time frame. So despite this looking generally clean, and this is kind of the contrast between, like, when you look at different types of bars, daily versus weekly versus hourly, it looks like a nice clean uptrend on the weekly or the daily could have extremely erratic price action underneath the hood if you look at the intraday price action. But if we just make a general observation about this stock during this weekly push, you can see that the 10 and the 20 have started sloping upwards. That's what this yellow and pink dashed line is. And you can see on an intraday basis, the 10 and 20 on the hourly has started sloping up. And then within this upslope, you start to think about, okay, where could I have entered this stock, during this movement? And typically, what most traders do when it comes to entry tactics is they enter on a pullback or they enter on a breakout from a range. So again, like if just from analysis perspective, if you just look at the pullbacks and you look at the ranges within this intraday time frame and within the context of this push, and you start making observations, you can see I have my bars colored to where the white represents a volatility contraction and the purple represents a volatility expansion. So basically below average bars versus above average size bars. And just from observing, I can see, there's periods of time where there's this volatility contraction and then it expands, volatility contraction, and this is a gap, but it expands. Volatility contraction overall, you can see there's this big sloppy bar here in the middle, but like the price was contracting and then it expands out of that, it contracts, expands, contracts, expands. So one of the fundamental aspects of supply and demand is this kind of expansion and contraction. And this is nothing new. This has been observed for more than 100 years by various traders. There's an expansion and contraction component to supply and demand and price action. And you can see that very clearly just with this first stock that we pull up. So when it comes to potential entry points, and again, this is just us observing price action and thinking about, okay, where would I have entered? It's like, okay, if you wait for these contraction areas and the price expands, that's often a good inflection point. Contraction, expansion, contraction, expansion, contraction, expansion. So as you're looking at stocks to potentially trade, what you want is to look for stocks that are showing some sort of pause or some sort of contraction area, with the idea that, and this ties into my recent post about outs when it comes to poker, is so this is the setup. We don't know how this is going to unfold. Like this could break to the downside, it could break to the upside, it could keep chopping sideways, but we have potential outs here. A winning trade, what would a winning trade look like? It's if this thing were to break out of this range and continue to follow through. That's what we're hoping for from this scenario. Whether that unfolds or not remains to be seen. We don't know that. And that's where the difficulty with trading is you don't know what happens on the right side of the chart. The price action's unknown at that point. All we can see and observe at this juncture is that the stock has made a move up, it's expanded, and now it's contracting. And we're looking for an expansion back in the direction of the trend. And one good thing about TC2000 is if you use these brackets, you can actually move back and forth in time. So this is another good technique to help you kind of train your eye to price action. If you go to the prior contraction, again, you have an expansion, you have contraction of price range. And again, we don't know what's going to happen on the right side here. This thing could continue to drop. This thing could go sideways. But we know at this point in time, just based on observation, there's a tendency to expand and then contract and then expand. So then you start, when you see this price action start to occur, your mind should immediately go to, in order for this setup to trigger and be valid, it has to expand. And what would expansion look like? It would mean this thing breaking above this range and expanding to the upside. So if it starts to do that, then that's your sign to get into the trade. If this thing continues to chop sideways or it starts going down, that's not unfolding in the way that you would expect it to in order for a continuation of this trend. So again, when we're looking at general tendencies, we have this tendency just based on this one observation: contraction, expansion, contraction, expansion, contraction, expansion. All right, so those are just some basic observations from one chart. Let's see how consistently that applies. So we have RGS, we have this massive gap move. And these are a lot more difficult. I mean, you can't really anticipate this sort of gap occurring. But, if you trade gaps, then that's your thing. I don't really trade gaps. I haven't had a lot of success with them. But if we take our general observations from this previous stock, contraction and expansion, and we just kind of zoom out a little bit in the intraday time frame, you can see there's this contraction area and expansion, contraction. And this is why we don't want to anticipate a breakout, because this contraction here, this right here looks an awful lot like this right here. I mean, there's not a whole lot of difference. If you look at this contraction area, had a nice up move, you had a contraction, and then it starts expanding out of that. And this one has a little bit of follow through. I mean, this is kind of what we're looking for generally. And then you have another contraction. Again, like what we're looking for at this point in time is we don't know what's going to happen next, but we're anticipating that this thing might break out or it might break down. So we let the price action tell us which direction things are going to go. We're not guessing, we're just observing. And then it's like, okay, this is why you don't want to buy in early, because you never know if it'll break out or not. This thing broke to the downside. So again, like we're just observing the price action that happens. So one of the reasons that I use the setups that I use, I don't trade these little short-term hourly consolidations often, but I trade them, but in the context of a bigger picture pattern. If you want to trade these short-term hourly consolidations and that be the basis of your trading, that's a viable strategy. There's a lot of day traders that do just that. I trade longer-term consolidations within the intraday chart. And so what often happens is, and this is just an observation from this chart, so if we look at IVP, there weren't a lot of areas where the 10 and the 20 were sloping down, which that would indicate a sell-off. So for these moving averages to slope down, it would indicate that the price action is sold off enough for those moving averages to pull back. So in RGS, that was the case here. So you have this period of time here where the 20 starts to slope down, the 10 starts to slope down, and then the 10 is under the 20 for a short period of time. So if you look at the areas of this price chart where it actually follows through to the upside, you have this zone here, and I used to do this a lot where I would just kind of mark off these bottoms here and just study like what is the price action at the bottom. And this is kind of where I talk about the Kale wedge pop, and I talk about basin breaks and things of that nature, because this is exactly the reason I use these strategies, is because I've done this analysis over and over again. So when you have these moving averages that are sloping down on the hourly, the 10 and the 20, oftentimes you end up with a V-shaped bottom, or you end up with a higher low bottom. And obviously in this case, you have one low here, you have a higher low bottom, and then it basically wedge pops through this declining 10 and the 20. And that's essentially what a wedge pop is, if you read Kale's methodology. And if you haven't, I would recommend getting his book or watching his interviews. He explains this stuff in pretty good detail. So in the case of this setup here, you have this longer term pullback, and if I look at this on a daily, you can see this was a 3-day pullback, 3 or 4 days, instead of this kind of 1-day pullback here. And if we go to IVP on a daily, it had one day of a pullback, but everything else was just kind of intraday pullbacks and intraday volatility contractions that weren't very apparent on the daily or the weekly. And in the case of RGS, again, if I were to enter this stock, it's like you don't know where this is going to stop. All you can see and observe, if we just back this up again, I like backing the price action up, so you understand, okay, what happened before the follow through. You have downward sloping 10 and 20, it starts to build higher lows, and then you kind of have this range here, and then the stock breaks out above that range, and then that starts to slope these moving averages up. So that's how you know you're going in the right direction. When a stock is acting normal after the breakout, these 10 and 20 start to slope up, and then the price action will continue to move higher. That doesn't mean it's going to blast off and go 3 or 4 R in the next hour. It just means that things are acting normally. As long as things are acting normally, then you will continue to hold that position and to let it unfold naturally. So that would be one potential entry area. And then this thing doesn't get far. It breaks out here, and then it rolls over a little bit later. And again, so we have another situation where the 10 and the 20 start sloping down. Again, if you just mark this bottom here, and this is still in the middle of bottoming out. It hasn't actually bottomed out and broken out yet. But we can observe, just based on the price action, a 10 and 20 are sloping down. You have this kind of sideways range that's being built. You have higher lows so far. Again, this thing could break down through the bottom here and continue to go down. And just based on the volume pattern here, this is one thing I don't like about this stock right now is it did have this big push on this gap day, and the volume came in super heavy. But if you look at the volume since then, it's been practically non-existent. And this is kind of what you call a one-hit wonder, where basically for just one single day, or maybe it's 2 days, you have this big influx of volume as people get excited about some news or some development in that company. If that's a real development and there's people and there's a lot of institutions trying to buy that stock, then you'll see this volume here continue to be very, very high relative to its normal volume. But the fact that this just had a pop for a day or two, and then it's just kind of done nothing sideways volume-wise, then this stock is not something that I would necessarily be interested in, despite the fact that the overall setup looks decent. If we go to EOSE, again, if you go to the weekly chart, you have you have like 5 up weeks. And then if you observe here, you just kind of had this pause. So basically, we're just going to study within this 5-week move. We only see one pause. From a weekly perspective, there weren't a lot of good entry points that I could have taken advantage of. And if we go to the hourly chart and we zoom out a little bit, you can see there was a push up and then a pullback to the moving averages. There was a push up and a pullback, a push up and a pullback. So again, what I want you to observe is like, okay, how does this pullback end? What does it look like? What were the characteristics of this pullback when it ended? And what are some consistencies that you can find when it comes to studying this price action? So if we just go back to this specific time frame, you'll notice you have a down sloping 10 and 20. You have a higher low pivot here that's starting to be built. You have this range, and then it breaks out. That sounds an awful lot like what we just saw over here, right? Again, these are completely different stocks. I'm just trying to help you understand the tendencies that often happen with stocks when it comes to supply and demand unfolding. So here we have a consistency with these two stocks. And this is one of the major patterns that I use in order to get into a stock. Is a 10 and 20 sloping down into so basically this purple and pink line here, or pink and yellow line is the daily 10 and the 20. You have upsloping 10 and 20. You have the price action pulling into that. You have this zone here where the 10 and the 20 on the hourly are sloping down, and then you start building higher lows. And then you break out of that and you have some movement. So that, again, this is a consistent observation that I've had. And again, I'm not going to go over all 122 stocks in this list. I just encourage you to do the same exercise and observe whatever you observe. Maybe your observations are completely different than mine, and that's fine. But you should be able to analyze the stock market, analyze chart patterns, analyze supply and demand over and over and over and over again, and what you'll end up coming away with are general conclusions about the nature of price action. And that's essentially what you want to understand, is like understanding the general nature of price action. Because what you'll find is there are no absolutes. People will talk about, oh, this stock has a certain character and blah, 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 and it's like, the stock's character changes consistently, even within the same stock. So it's not like, even if you compare two different stocks, the character looks different, even within the same stock. As that price action unfolds over time, that characteristics are going to be different. Like, so the way this bottoms one time is not going to be the way it bottoms the next time. And that's the thing about trading, is that's difficult for people to comprehend. And they try to create all these scans, and they try to create all this structure without really realizing that's not how stocks move. Stocks don't move in this predefined neat box where every time that it bottoms, it's going to look like this. Because if we go to the next time that this thing bottoms intraday, it's more of a V-shaped bottom. But generally, what I can observe is it starts to slope the 10 down, and it starts to slope the 20, or it went sideways a little bit. But it's just the reason both of these slope down here is because this is a longer consolidation. This starts to look like this. You can see that there's some similarities in the way it starts to look. It's just this ends up being a longer consolidation, whereas this kind of V-shape bounces off and then it continues to move. And again, this is my observation, and this is what I'm often looking for, is the first sign of a correction is this 10 period on the daily, on the intraday sloping down. And this is what creates basically what are basin breaks. So the difference between a wedge pop is the 10 and the 20 are sloping down before it pops out. Whereas with a basin break, the 20 period continues to be in an uptrend and the 10 will start to slope down, but it's like the 20 will catch it and then it'll just bounce from there. So this is more of a V-shaped bounce as opposed to a higher low bounce. And what about this third bounce? Again, you have the 10 sloping down, you have the 20 continuing to slope up, so this is more of a basin break look. Again, if you don't understand these concepts, go watch Cale's interviews and it should become apparent. He explains these things. So again, this is a wedge pop where the 10 and the 20 are sloping down. It finds support, it starts building higher lows, and then it breaks out. This is more of a V-shaped sort of bounce. This, again, this is V-shaped. This is more of a double bottom or more of a higher low bounce. And this is within the same stock, within the same couple of weeks. It's like for anyone to say that price action unfolds exactly the same in the same stock, it's crazy talk. That means they have not actually looked at price action, because within the same stock, within the same several weeks, there's multiple unfoldings of how the bottom happens. But again, you can make general observations. The reason that Koulamagi emphasizes higher lows is because oftentimes you'll get this higher low where you have a low and then a higher low, a low and then a higher low. That doesn't mean things always unfold like that. Here you have more of a V-shaped bounce. You don't get the higher low until much later. And yeah, you could say maybe this breakout here is the proper entry point. And that could be true, but I prefer in some ways to get this thing out as it's coming out of this consolidation, and then maybe this is where I would add. So that's EOSE. Again, the observation here is there's a consistent theme that, you know, when the 10 and the 20 are sloping down and this thing builds a higher low and it breaks out of that, there's often this sort of push out of that. The other thing that I'm taking away from here is that sometimes these are more V-shaped. All right, let's go to EPLD. If we look at the weekly, so again, like just studying price action, this trend looks decently intact. You know, it moved up 100% just in a couple of weeks. And you see that there was this kind of really sloppy, choppy kind of 3-week period. So this stock in general is a little bit more sloppy than the other two, the other several that we saw. And even if you look on an intraday basis, if we take this period of time here of this 3 weeks, you know, that's this range here. If we just kind of mark out the lows, and again, this is just us observing what does it look like when the stock bottoms. What are the characteristics of the stock when it bottoms? So these are good areas to study. You know, if you look at this previous uptrend as this thing slopes up, there's a couple areas here that I'm seeing where, you know, if you just kind of mark out the lows, where the 10 and the 20, either the 10 and the 20 or the 10 is sloping down, it can kind of give you some areas to study. All right, so if we just back up a little bit on the intraday. Again, we're just looking at general tendencies here. So if we study these two pullbacks, again, you can see the 10 starts to slope down. The 20, they don't cross, and the 20 kind of holds, so this is more of a basin break sort of look. But again, you have this kind of hourly price consolidation, and then you have a break above that. So again, just as a general observation, these are really good areas to look for stocks. Look for stocks that are having this sort of consolidation here. After their moving averages start to slope up, you look for these little consolidations, and then you look for breakouts above them. And this would be your entry point here. As these things are breaking above this range, and then you would put your stop under the lows here of this pivot. Some people will put their stops below the breakout bar itself, or you can do a layered approach where you put, maybe half of your position stopped here and then the other half here. That way, if this impulse bar that's breaking out kind of loses its steam, then you get out of half the position, and then you only close it out if you get fully stopped out. Again, this is just kind of your own personal preference. There's different strategies when it comes to stop placements. I prefer to use the pivot lows for my stops, but it's on you to determine your own risk management strategy. So this thing, it breaks out and it moves a little bit, and it doesn't make some massive move. It makes like half of an R of a move before it pulls back into another pullback. And again, if I just start looking for areas where the 10 starts to slope down, this was a little bit of a longer consolidation. Sometimes they don't wait. It's nice for you to think the stock's always going to wait to give you this perfect formation, but it often doesn't wait. That's why as soon as I see this 10 start to slope down and it starts to build a little bit of a range, I start being on alert for a breakout. Whether that breakout comes or not is not within my control. I just know what to anticipate. I know what to look for when it comes to what am I looking for to enter the position. What price action needs to unfold for me to initiate? What price action needs to unfold for me to pass on the trade? And again, this thing, it breaks out here above this range. It's a short range, and then it follows through from that point. So these are these two price areas, and again, like the movement off of this pullback was much greater than the movement off of this pullback. And that's the other thing that's hard to tell is after you enter the trade, you don't know what the stock's going to do after. And that's kind of the challenging part with trading. And this is where we get into this really sloppy period here, these next couple of pullbacks. And again, like this happens with stocks frequently. You have to understand that this is normal, and you have to understand how to handle this price action and not get discouraged, because this is the reality of trading, where it's pulling back to the moving averages. I have this nice range that's being created here. And again, let's say that you saw this pullback here in the 10. You see how the 10 is starting to slope down, and it starts to break back above. I mean, this could have been used as a valid re-entry after this pullback. It's just the stock doesn't really go anywhere. So if you're looking at what normal looks like, and it starts off normal as it moves out, and then it starts to become abnormal. And when you start seeing this sort of action after entry, this is not about right and wrong. This is you observing how the price is unfolding. So unlike the other several setups that we showed beforehand, where the price action continued to see a upward sloping hourly 20, in this sort of scenario, even though it looks similar from the entry point, it starts to become abnormal and starts breaking back through these moving averages. So like this is the point in time where you have to reassess the trade and to think, okay, like this isn't working out similarly to like I saw here. I didn't get the follow through. The moving averages are now starting to go in the wrong direction. So you start to kind of reassess your position here. And maybe this is the point in time where you cut this position here because you thought, because you don't know this is coming. All you see is this. So there could be a point in time where you either trim or reduce your position because it's not following through the way that you thought it should. And then lo and behold, you get this breakout bar, above this price range here. So it's like, okay, and this is the challenge with trading is you don't know what's coming next on the right side of the chart. You make decisions on what's happening now. So whether you decided to cut or hold this whole thing, like I probably would have trimmed at least some of my position as it was breaking through here, and then I probably would have added it back here, because that's just, if you look at what you're seeing right at this moment, that's what is being shown in the price action. And things start looking normal after this breakout attempt. You know, up until this point, things look pretty normal to me. Like this would be a normal pullback. I would actually be looking at adding to this thing on a potential break of this range, because you can see like there's a range there, and then you know you start building another range here. You know, oftentimes these end up being good add points for stocks. But you know, much to the dismay, I didn't take this trade, but you know, if you were in this trade, it doesn't matter what you were thinking here. Like you could have the best of intentions for this trade, everything's looking great, and then once you start seeing this action where it breaks down through the moving averages and things starts to slope in the wrong direction, at this point it doesn't matter what you thought here. What matters is what's happening now. And there's a lot of traders that they'll get in here, and once they see this negative action, they kind of clam up and they don't know what to do, and then they'll just hold and hold and hold as this thing just starts bleeding out, and they just are losing more and more money as they, you know, kind of freeze deer in the headlights. And that's what you don't want to do. So again, like, you know, you have these different points in here. And again, this is just about observing price action. You know, if we go to these next two pullbacks, I hope it's apparent to you that even within the same stock, you can see how none of these bottoms ended up looking the same. This bottom doesn't look like that bottom, which doesn't look like this, which looks different than this. And the way that they unfold after the entry looks completely different. So to think that a stock is going to unfold exactly the same every single time just isn't in line with reality. So again, after this failed breakout, it pulls into this longer consolidation. So now we get more into the down sloping 10 and the 20, which is more, like I said, like more of an often a wedge pop sort of scenario. And you can even imagine, as this thing's pulling back here, like this is looking like the higher low sort of wedge pop that we've talked about before. Like this looks like a pretty clean setup. And actually, I think during this period of time, I was looking at this, you know, because if you just imagine you draw some trend lines here and you see this down sloping 10 and 20, we're looking for this thing to pop through this price range here and kind of kickstart this trend again. But we can see that's not what happened. So that's why you don't want to anticipate this thing breaking. You want to actually like have the price action confirm your thoughts rather than you anticipating and wishing for the best. So this is a breakout point here. And again, this ends up being a V-shape sort of bottom here. So oftentimes you want this sort of like higher low wedge pop through the 10 and the 20, but in this case we get more of a V-shaped bounce. And again, that's why I want you to do this exercise regularly, because it helps you understand is like not everything plays out exactly like you want it to. I'd prefer a higher low bottom, but this doesn't give a higher low bottom, it gives more of a V-shape. And that's why over the past couple of years I've become a lot more comfortable buying these sort of V-shaped scenarios, because I've done this exercise time and time again, and I've noticed that in a lot of the cases, even though I want some sort of higher low like this, sometimes you don't get that. The market doesn't always give you what you want. So you can either pass on these V-shaped trades, assuming that they're more failure prone, because that's what some people do, is they're like, oh, that's more failure prone. My observation is they're not any more failure prone than anything else. So whether you agree with that observation or not, that's on your own analysis and your own judgment. But I will often take these V-shaped wedge pops back through the moving averages, because I've seen time and time again where this is more of a shakeout. It undercuts a lot of price action. It'll shake a bunch of people out, and then it kind of grinds slowly back up, and then it'll break back the other way. And what that does is it fuels another leg up, because all these folks here that ended up getting screwed by this shakeout, they end up having to clamber back into the stock and get in. So oftentimes, even though this isn't ideal in some people's opinion to have these V shapes, you do get some follow through. And this doesn't lead to some like massive rally afterwards, but it's enough price action to get, so this is a 12 ADR stock. If you were to get in here, I mean, that's, almost 2R of a price move. You probably could have taken some sort of profits. Let's say you got in here and you waited for this rollover. I mean, that's almost a 1R gain just from this little impulse here, even though ultimately the trade didn't work out. And sometimes you make a lot of your profits on these little short-term blips that where you take partial profits, or you take a third or a half off, and then it rolls over and it stops you out at break even. That's still money. That's still gains added to your portfolio. And a lot of times, especially in choppy markets, that's going to make up a lot of your gains. It's not going to be these big pushes here. It's going to be these little 2 and 3R gains that end up rolling over and stopping you out for a scratch on the rest of the trade. If we go to this last little consolidation here, again, I prefer these sort of longer term pullbacks where the 10 and the 20 on the hourly are sloping down, because that means you have more trapped buyers. That means you have more folks that have sold off. You have some of the excess supply that's being removed. So these sort of scenarios here create a more reliable base than some of these little short-term blips and patterns. So even if we so let's say that we're okay with V-shaped bounces, okay, and this is just another example. Like this V-shape here looks an awful lot like this V-shape here. So if you had taken this trade here just based on this V-shaped bounce, you probably would have taken this trade here. It's the same sort of scenario where you have this sharp sell-off, and then you have a recovery that's more of a V-shape. And this is what a lot of folks will conclude with V-shaped bounces is that there's a lot more volatility, which is true. V-shaped bounces do have a lot more volatility. So a lot of times if I take a V-shaped bounce, I'm not going to have my stop down here. I might take a smaller position and have my stop, much lower in the price action. So that way I have the ability to hang on during some anticipated volatility. So this thing, it breaks back through this price range here, and then it starts to pull back immediately. So if you want to dump this position, as soon as this thing starts to roll over, then that's not a bad strategy, honestly. If you want to have your stop a little bit lower and be able to kind of sit through some of this chop and churn, that's another strategy as well. I've seen both. I've used both. There's trade-offs with either approach. So this is when we start building the more reliable bottom. You have higher lows starting to be built. You have the price action kind of squeezing into these declining 10 and 20. You eventually have the 10 starting to roll up as well. And this is where when you get the more kind of reliable bounce. And again, whether you took this entry here and then cut, or whether you took the entry and then held and then added here on this unfolding of the bounce looks way different than this unfolding of the bounce. So again, if I want to have you take anything away from this approach, is if you do this enough, you'll start to learn that there are so many ways that price action can unfold. There's so many ways and so many nuances that price action can unveil itself. So if you have these rigid expectations and these rigid ideas of what has to happen or what needs to happen, then you're not really trading in line with reality when it comes to trading and observing supply and demand. What you need to do is have general approaches that are going to get you in during inflection points and in some ways help you manage some of the volatility that often happens at these inflection points without getting kicked out, or at least have a re-entry tactic. So the tighter your stop is initially, the more likely you're going to have to re-enter because you're going to get stopped out. So you can get bigger positions with tighter entries and tighter stops, but you're also increasing your likelihood you're going to get stopped out and have to re-enter. So for those that use very, very tight stops, the one thing you need to keep in mind is you might be entering the same position 2 or 3 times because you're going to get slopped around and chopped out. But ultimately, when this thing takes off, you might end up having a bigger position. The other strategy is to put on part of the position and then let the price action unfold a little bit and then put on another part of the position. That way you can kind of get the full position on while also managing this volatility that happens quite frequently from these inflection points. So again, I'm not going to go through every single stock here. What I tend to do, this is 120 stocks. I'll go through a number of stocks on my own, and I'll just observe the price action, and I'll just see, okay, where would I have entered? What would be a good spot to enter on these stocks? I'll take these tools here, and I'll just, I'll start marking out the bottoms. And oftentimes what I'll use as a reference point is like, okay, where did the 10 start sloping down, and where did it come out of that? So I would consider this a near-term bottom to study. This would be a near-term bottom. This would be a near-term bottom. And again, what all I'm doing is I'm marking out these bottoms, and then I'm going back to that price area, and I'm thinking, okay, what does it look like before the bottom? So there's basically this up move. There's this sideways range. In this case, the volume dried up really nicely. You hear that talked about frequently. Where would you get in on this? I mean, there's undercut and rally sort of strategies. There's breakout approaches. I'm more of a breakout trader, so I usually wait for it to break above the range. So I would be getting in, at this point in time. So for that's the one pullback here. If I go to pullback 2, so this had basically a W bottom. This is more of a higher low bottom. So if you just wait for the 10 to slope down, this is a basin break sort of approach. The breakout would be here, obviously, on these expansion bars. And that's another reason I use these colored bars, is I can see when the price is expanding. So when I see this expansion bar out of this range, then that's kind of my sign that things are kicking into gear. You can even use the Bollinger Bands as a trigger. So like when this Bollinger Band gets violated, then that could be another trigger for you to get into the trade. Sometimes you get in a little bit later than you would down here, but you also avoid a bunch of false breakouts by doing so as well. Again, you have the sideways range. You have the purple bar pushing out of this range. That's another setup. Sideways range. This purple bar is trying to push out. This is another purple bar pushing out. But again, you have this range here. You start building higher lows. You have this breakout. You have a range. You have higher lows being built. You have a breakout. So again, like when I talk about having these higher low ranges and breakouts of the intraday shelves, I'm not saying this because I'm just making shit up. Like this is, again, something I've observed over and over and over and over again, just doing the simple drill. And this should be the basis of your strategy formulation. Mark out these bottoms, observe the price action, observe where you would get in, observe where you would put your stop, and then a consistent theme will show up over time. And again, my consistent theme is you have these pullbacks in the 10, at least, and sometimes in the 20. You have a range that's built, and then you have a breakout. So my entry point would be at this breakout, and my stop is often at the pivot lows here. You have a range, a breakout, my stops at the pivot lows. You have a range, you have a breakout, my stops at the pivot lows. You have a range, you have a breakout, my stops at the pivot lows. So again, like that theme that you hear me saying over and over and over again, the reason I do that is because that's just how price action moves. That's not me just making stuff up. It's not because I heard it from somewhere. And if I did hear it from somewhere, I only believe it because it's consistent with the themes that I'm actually seeing with my own experience. There's a philosopher, Thomas Campbell, who basically said if it's not your experience, it's not your truth. This is how you build experience. This is how you build repetition. This is how you build procedural memory, as Stockbee calls it. Is if you do this sort of process where you study price action and how it actually unfolds, you start to build and understand, okay, I don't care what anybody else says. I don't care what Minervini says or Kulamagi or Zanger or any of these guys. I don't care what they say if it conflicts with what I'm actually observing in the charts. Now, again, it would be kind of foolish to not listen to them because, trust me, they've done the same exact thing. The reason they say what they say and the reason they do what they do is because they've done the same process. And their observations aren't exactly my observations, and that's okay. But ultimately, all of us are doing the same thing. We're studying supply and demand. We're studying how stocks actually move, and we're formulating strategies to exploit that movement. And my vast observation of doing this over and over again is like, again, you have these shelves, you have breakouts, shelf, breakout, shelf, breakout, shelf, breakout, within the context of this bigger picture move. So again, I would encourage you to do the same process. Take the stocks that have moved over some period of time, over the last few weeks, the last few months, study the stocks that have made the biggest moves, contrast the daily or the weekly chart with the intraday and kind of see, where does it bottom, how does it bottom, what did it look like before it bottomed, where would I have gotten into this stock after the bottom, where would I put my stop, how would I manage this trade. Those are all questions you need to have answered to formulate a strategy when it comes to your approach to trading. And that approach is going to be slightly different based on your experiences, your observations, and your risk tolerances and your personality, essentially. All right, folks, I hope you found this video to be helpful. I hope that you take these concepts when it comes to studying price action and supply and demand, and I hope you incorporate them into your own processes. Do this daily, do it weekly, do it monthly, do it, and you will become a better trader because of it, I promise.